Welcome to the latest edition of LPL Market Signals. Jeff Bookbinder here, your host for this week with Barry Gilbert. Filling in for Ryan Dietrich this week, who was off enjoying his anniversary vacation. So Ryan, we miss you. I hope you're having fun. We will try to put on as good a show as possible for all of you today. Barry, welcome to the show. How are you today?
I'm doing well, Jeff, and it's great to be here joining you. I can't substitute in for Ryan. He is inimitable, but I will do my best.
Beautiful. Well, here's what we got action-packed today. We're going to start by saying goodbye to a great American. I'm sure all of you listening know who that is. Well, as we always do, we'll just give a quick stock market update and then move into the bulk of the content here for today. Three topics. Number one, earnings season just got underway last week. So far, so good, but we are seeing signs it's not quite going to be as good as it's been the last couple quarters. Next, we're going to talk about consumers, which consumer spending is holding up pretty well considering the challenges. So we'll talk about the retail sales numbers we got last week. And then lastly, given Barry's title as the LPL Research Asset Allocation Strategist, we are going to play Stump the Asset Allocation Strategist. Say that 10 times fast. So we'll ask Barry some tough questions, and I'm sure he'll give us good answers. So let's start on a somber note. Barry, we lost a great American yesterday, Colin Powell. This one hit home for me. Because I've seen him speak so many times. We were privileged to have General Powell speak at the LPL Focus National Conference a number of times, including last year, actually, and really inspiring. So he will no doubt be missed. I think there's something that politicians on both sides of the aisle can agree on. Really a great guy, and really inspiring, dedicated his life to public service. He'll be missed. Do you have any thoughts, Barry? What struck you when you first heard the news, other than the obvious sadness?
Yeah, a pretty extraordinary person. I love his 13 leadership principles. You can Google it. That's inspiring. My favorite is the 13th. I think is last potentially to highlight it. Perpetual optimism is a force multiplier. And there's somebody who knew about force multipliers as a leader within our armed services. So great quote, 13 Principles of Leadership from Colin Powell. Give it a look. It is inspiring.
Yeah, absolutely. I looked at those yesterday too, Barry. One, it ain't as bad as you think. Just wake up the next morning and things will be better. There's the perpetual optimist that he was. Get mad and then get over it. I think those are certainly words we can all live by. Share credit. That's certainly something that we on our team here and in the LPL Research Department try to do every day. No doubt a very positive message, I think. So those are some, but yeah, I'd encourage all of you to look at those 13 principles. They're really good. So Colin Powell, we'll miss you, and thank you for all you did for this country. So moving on, there's no good transition from that. So let's go to the quick stock market outlook, Barry. So we had, the 5% pullback and rallied right back again. Now we're less than 1% from the all-time high, I believe, as we're recording this on Tuesday morning. Really a nice bounce back. The latest rally, I think, has been probably driven more by earnings optimism than anything else. We bounced back above the 50-day moving average. We're in the positive seasonal time of the year. Things are set up pretty well here for another rally. What do you think?
I think things are well set up. Earnings is the basic driver of the stock market. That's the most important thing. And we've had just an absolutely incredible earnings story. And the earnings season just launched. And when you see earnings driving the market, those are the right things being lined up. So pay attention to the earnings story. It just started earnings season, and it's going to continue to evolve. But so far, so good. That's really your area, Jeff. What have we gotten from earnings season so far?
Yeah, it's off to a good start, probably a little better than I expected. We'll get more into that a little bit later on the podcast, but yeah, so far I've been impressed. I guess the one watch out is we've had a lot of financials, and those are the companies that aren't really as impacted by the supply chain disruptions. They're a little bit impacted by the wage pressure, but to really get a good feel for the impact of the supply chain disruptions and materials shortages and all that, we need to hear from companies in other sectors. So that'll be a key to watch. So let's move on. Pretty positive near-term stock market outlook. Talk about the consumer, Barry. So got retail sales last week, and they were really good relative to expectations. That blue bar, for those of you watching on YouTube, the blue bar doesn't look like it's up much, but it was about a 1 percentage point upside surprise versus economist consensus expectations. That's a big upside surprise. Now, there's a lot of challenges facing consumers right now. We all know most of them are COVID related, right? A lot of jobs are hard to fill and a lot of goods are tough to get. And that makes it tough for retailers to actually, fill the orders that they've got. So that was a headwind. And then you still got shoppers, some at least shoppers, a little bit concerned about the COVID environment, which is still affecting consumer behavior. Despite those challenges, to see this strong month over month gain in retail sales was really encouraging. Thoughts on that, Barry?
Yeah, this tells us that there's still strong demand out there. We know that we have supply chain challenges. We know that they're weighing on the economy. But as those resolve themselves, is the demand going to be there? And at least when you look at the picture from the perspective of the American consumer, the answer seems to be yes. There was rotation in spending from services to goods with COVID. That means service spending levels are still low. Those are going to come back as the environment comes back. The demand is there. Savings are fairly strong right now overall. It's a good picture from consumers. Consumers drive, depending on how you look at it, 2/3, 70% of the US economy. So found this encouraging.
Yeah, we're not going to see the same kind of consumer spending growth that we saw in the second quarter. The economy has slowed quite a bit, largely because of Delta. But consumers are still in great shape, agree 100%. With all those savings, stock portfolios are up, housing prices are up. The wealth effect is certainly helping. All that savings that you mentioned, Barry. So we think the outlook is quite positive for consumer spending over the next couple of quarters, no doubt. And that's, as you mentioned, big driver of the economy. So positive story there, which should help support the economy and stock market. Actually, one last thing on consumers, I noticed there's something called the financial obligations ratio, which compares debt service costs to discretionary income. So basically, how easy is it for consumers to pay their debts? And that measure is essentially at a 40-year low. In other words, consumers' incomes are covering their debt at the highest ratio in about 40 years. It's really tremendous and just points to how good a shape consumers are in right now. So let's go to earnings. I kind of gave a sneak preview there, but let's dig in a little bit deeper. So we expect a really strong earnings season in terms of growth. But as you can see on this chart, for those watching, going to be a lot slower than last quarter. Well, why is that? It's because we had easier comparisons last quarter, right? You're comparing to Q2 2020 last quarter, which was when the lockdowns were. This quarter, we're comparing to Q3 2020, which was certainly a quarter that saw a lot more economic activity and a lot more in terms of corporate revenues and profits. So don't pay too much attention to how big that slowdown is, right? We're probably looking at slowing from 90% growth to 35, maybe a little better, maybe high 30s. But that is still really strong growth. So that's really, I think, the first key point to keep in mind. This is a strong gain in earnings. Company's still in good shape. Now, because the supply chain disruptions are intensifying, and frankly, these labor shortages and material shortages are really throwing a lot of kind of wrenches at corporate America. We're probably not going to see as much upside as we saw the last couple quarters. So coming into the last couple quarters, we saw about 25% upside. Maybe we get 10% upside this quarter, but that's probably as good as it's going to get. That 10% upside would put us in the high 30s. We haven't seen estimates rise as much. We've seen more negative pre-announcements. It's still a positive story. We're still hearing more good things than bad things, but the ratio of those pre-announcements has weakened a little bit over the last couple of quarters. And that suggests less upside. So, that's what we see. We're only about 10% in terms of the number of companies that have reported, and we're seeing good beat rates right around 80%. We're seeing nice upside surprises, but again, it's mostly come from financials, which don't face quite as many challenges as traditional companies. So what are we watching? First, how long will these supply chain issues last? We're going to be listening closely to hear from companies about their thoughts on that. I mean, we've heard from a number of companies how difficult the environment is. Procter & Gamble was the latest this morning. They're trying to raise prices to offset the higher costs. It's not easy. Other companies that have expressed concern, Sherwin-Williams, Nike, FedEx, companies across a variety of sectors. There's certainly others struggling with these supply chain issues. It's probably the number one issue for corporate America. Number two, outlook for wage increases. This concerns us a little bit. Probably be a bigger problem in a quarter or two than it is right now, but wages are up solidly year over year, and that probably will continue because if you can't fill a job, tend to pay more to attract talent. That is going to eat into corporate profit margins, and we may see a little bit of a margin compression in Q3 relative to Q2. And the last thing, because we're going to probably see smaller upside surprises, it makes sense that stocks would not react as positively to upside surprises. We're already seeing that. Actually, if you look at the companies that have beaten estimates so far, those stocks are only up about 1%, which is not much. That's fairly typical, but not much when you compare it to how much the stocks that miss earnings are being punished. They're down about 4 to 5% on average so far. That's a little bit bigger of a negative reaction than we typically see. So there's another kind of piece of evidence that this is just a trickier quarter, and investors are a little bit more on edge. So I guess with that, let me turn back to Barry and see if you have any questions or concerns or that I didn't mention, Barry, about earnings season or just any thoughts in general.
Yeah, I think one of the keys with wage increases is going to be whether productivity can increase. If people's wages are higher, but at the same time, they're growing more productive because they have access to more or better technology, it can offset some of those wage increases. So concerns about that pressure, certainly, but also want to see what's going to be happening on the productivity side.
Productivity is so important in containing inflation. It's generally helped, I would say, during the pandemic, but that task is getting certainly tougher with the labor shortages that we've seen, the increase in wages, and the fact that we've already invested so much in technology. Incremental gains might be tougher to achieve. So good call out there, Barry. So next is the part of this podcast that Barry's been dreading for the past 24 hours since we figured out that we were going to use this format. We are going to play Stump the Asset Allocation Strategist and ask Barry 3 tough questions. Barry, I thought about not telling you what the questions are in advance to really make this tougher, but unfortunately, you do know what the questions are. You didn't have a lot of time to think about it, though, because we just came up with these last night. So there's still a risk that you get stumped. So let's move on and we'll ask these three questions. So question number one, stocks have come a long way. Does it still make sense to overweight equities? What do you think?
Yeah, I'd ask the people out there to think about that for themselves first. My guess is a lot of people said no. They thought about it in their own minds. And historically, that's actually good for markets. Pessimism about markets is a positive. And you do see in sentiment right now that there is pessimism out there right now for markets. The most dangerous time for markets is when people believe that markets can never go down and everybody's buying because of fear of missing out. That's pretty solid support. You look at the outlook overall for the economy. We're facing some important headwinds, but the growth outlook is still above the trend that we were in the last expansion. That supports, in particular, sales for companies, which gives a little bit of a boost to earnings growth as well. We already talked about the fact that for stocks, earnings are really the most important fundamental. We did mention that there was a lot of technology adoption. Might still have a little bit more room to run. There might be some benefits from that. We've seen the workplace flexibility. Companies have just gotten better at running lean and running smarter at the same time. It's a pretty incredible response. So you talked about earnings season, a tougher earnings season, but still things that are supportive, probably just overall economic growth as the first. As we said with retail sales, demand is still out there. Just a question of supply catching up. So you take the overall sentiment, which leans negative right now. That's actually positive for stocks. You look at the economic backdrop, which is still supportive. And even if the earnings environment is growing more challenging, we do still think it's a good environment for stocks. And so we do think it still makes sense to overweight stocks. Throw in one last thing, which is bonds. Interest rates are low. That's good for stocks for two reasons. One, it means that their borrowing costs are low and they can invest more easily. The other one is it means that the expected returns for bonds are low, and that makes stocks more attractive. Put those three things together, and we think you have a pretty good picture for stocks. We're still overweight.
I think you handled the first test pretty well there. I think calling out bond yields at the end there is a really important point for me. Because even if stock returns going forward might be a little bit more modest, well, maybe a lot more modest than what we've seen over the last 18 months, that hurdle to clear to outpace bonds is pretty low. So let's go to the second one. I didn't swap in a question you haven't seen. It is, although this I think is probably the toughest question of the three. International equities are really cheap. Is it a good time to add exposure? Barry, international equities have been a value trap for quite some time, at least based on relative performance. Frankly, at least developed international markets have been very weak recently. So what do you think? Is now a good time to jump in?
Yeah, let's take emerging markets first. I think that one's a little bit easier for us. Emerging markets now, just because of the size of its market, fundamentally means China. We still have concerns about the arbitrary and heavy-handed increase of regulation in China. And really the challenge there is that it creates unknowns. It could happen at any time, in any way. Investors don't like unknowns. We already do see it weighing on the economy in China, I believe. So there's a little bit of backing off at this point, but that remains an ongoing concern. So we're shying away from emerging markets a little bit. We still like the overall growth prospects. It's not just China, but shying away from that direction. The harder decision is the international developed equities and the US. We think that the picture for international is looking better. We still favor the US. We favor the US because of its emphasis on tech, which is allowed it to control margins. As value improves, that is a little bit better for international. But we've liked the flexibility that you see in the US. We've also seen a strengthening dollar, which has favored the U.S. That's another trend that might reverse. So we're watching for things for international to become more of a favorite. We're not there quite yet, but we're having active debates. We're having active discussions. Our view would still be overweight the U.S., underweight emerging markets, stay largely neutral international developed, because there are actually some good stories there. Now, Jeff, you talk about international equities, take a look at this regularly. What are you seeing right now?
Yeah, I think we've got to move past COVID globally. Hopefully that happens soon. But once we do, and we can have a synchronized global economic expansion, then the rising tide lifts all boats. That may be when Europe and Japan start to perform as well or better than the U.S. So that's really the key for me. And I mean, you mentioned the dollar. That can certainly help if we do see a reversal. Dollar's been very strong recently. Dollar weakness combined with a coordinated global economic expansion, I think, could be a good recipe for Europe and Japan. But unfortunately, we're just not quite there yet. So thanks for those thoughts, Barry. Let's go to the last one. Yeah, I guess this is probably just as tough as the international questions. How do you get income from bond portfolios, right? Rates are very low. It's been very frustrating. Savers are being punished by the Fed's low rate policy, certainly, and market-based interest rates. Very, very low. It's so tough to get income. There's no panacea for this problem, Barry, but can you share some ideas with our listeners on maybe where to get a little extra income right now?
Yeah, if you want a little extra income, you have to take on a little bit of extra risk. And the key question is really, where should you be taking it? So one opportunity that we see to diversify a high quality bond portfolio is to look at the bond sector called bank loans. These tend to be floating rate, so they're not as sensitive to interest rate increases. They tend to be higher up in the capital structure. So should they default, their recovery rates tend to be better. Again, it's risky, right? It is a riskier asset class. We're no longer in the investment grade universe. But when we look at the different options that we have, we think that that's one way to add a little bit. If you're looking at a payoff for relatively low interest rate risk in the high quality universe, we still like mortgage-backed securities. So that's not necessarily going to increase the overall income, but it's going to increase the income for the amount of interest rate risk that you might be taking on. Interest rate risk, when interest rates go up, bond prices go down. Interest rates up, bond prices down. And so the more interest rate sensitivity that you have in a portfolio, the more vulnerable you are to that. Both mortgage-backed securities and loans, they help insulate from that a little bit. So we think that those are two good options. Keep the loans position fairly light because it is risky, but it will add to the income.
Yeah, we do think rates are going to gradually rise in the years ahead. And so, at some point, those yields will start to look more attractive and it'll be a little bit easier. But we're certainly, we've been struggling to find income for a decade, probably going to continue to struggle, for the next couple of years. But rates probably still headed higher. It's just, it's going to be a slow grind. So thank you for that last answer, Barry. We got through the three questions. I don't think we stumped you. So nice job handling those. Certainly, these are a lot of questions we're getting from our 19,000 LPL advisors regularly. In fact, yeah, these might be the three most common questions we've been getting lately, other than questions about DC and the goings on there. So the last thing, we get just a couple minutes left. It's just kind of preview the week. I mean, it's earnings, right? We get 80 S&P 500 companies in total this week, and everybody, ourselves included, are going to be looking for these supply chain updates, right? I mean, in fact, I saw a stat the other day. I think Bloomberg was tracking the number of times the phrase supply chain was was uttered in a conference call, and it was like thousands already. I mean, just it's really all supply chain and wages. It's really all I think that people are going to be focused on this earnings season, because we know that the demand picture is pretty good. So we'll be watching that closely. Of course, we've got to continue to watch COVID trends. And then DC negotiations. I mean, really, the economic calendar isn't that interesting this week. Even the DC situation is not that interesting because, Barry, we just talked about this before we jumped on here. It might just be behind closed doors this week, and next week when the Halloween deadline approaches for the infrastructure package, that might be where it gets more interesting, right?
Yep, completely agree. We know that the Democrats have a narrow majority in the House and in the Senate. That means that you have to keep everybody happy, and that's tough in a group of large people. And they're trying to figure that out behind closed doors right now, see if they could arrive at a compromise. But it's not going to get interesting for markets until they get a better sense of what's actually going on.
Yeah, this negotiation is going to be fascinating to watch because the moderates are really holding their ground, and it'll impact virtually everybody, right? I mean, because we're talking about taxes, big time spending, and big time tax increases. So we're still watching, but we're probably not going to get any breakthroughs this week. We'll see. But keep DC on your radar. It's nice though that the economic calendar is quiet, so we can focus on earnings, because that no doubt is what matters most this week. So I'm going to end the call. We started on a somber note with some thoughts on Colin Powell's passing. We'll end on a happier note, which is today is my daughter's birthday. So happy 10th birthday, Emily. Looking forward to celebrating with you and family tonight on a Zoom. Most of my family is, actually all of my family is not in Boston. So we do a lot of Zooms. So be fun. We actually had this local rescue zoo bring some animals over last weekend, and Emily had some friends over, which was a lot of fun. You guys can ask me offline about some of the funny animal stories. We could have had an alligator and a snake. We chose not to do those. We did more of the cute, cuddly, furry type animals for her party over the weekend, which was a lot of fun. So happy birthday, Emily. Happy number 10. I love you very much. So with that, thank you, all of you, for listening. And thank you, Barry, for joining. Great content today. We were able to pack a lot into a half an hour. And Ryan, we missed you. We'll be back. It's probably going to be myself and Ryan next week. But the most important information you all need is that Ryan will be back. He does such a great job. So looking forward to having Ryan back. So with that, thanks everybody for joining. Really appreciate it. Thanks for listening to another LPL Market Signals podcast. We will be back with you next week. We'll see you then. Thanks.